December 2025. While you were shopping for Christmas gifts, something happened in the shadows of global finance, something massive, something that hasn't been talked about enough. The world's biggest money managers just executed what analysts are calling the trillion-dollar shuffle. Over $1 trillion shifted positions in a matter of weeks. Vanguard, BlackRock, State Street, CalPERS, Norway's sovereign wealth fund, Japan's government pension, all moving simultaneously, all selling their winning positions, all rotating into bonds, all going defensive at exactly the same time. The media called it routine year-end rebalancing, portfolio housekeeping, nothing unusual. Move along. They're lying to you. This isn't routine. This is a warning signal. A red flare shot into the sky, a preview of what's about to unfold. Because here's what nobody's telling you. This exact pattern has played out 3 times before in recorded history. Rome, Weimar Germany, medieval Europe, and every single time it preceded complete economic collapse. Right now, January 2026, the United States national debt stands at $38.4 trillion. Let that sink in. 38 trillion. It added 2.25 trillion in just 1 year. $8 billion per day, every single day, including weekends, including holidays. $8 billion added to the debt every 24 hours. Interest payments on this debt just crossed $1 trillion annually. Read that again? $1 trillion just to service the interest, not paying down the principal. Just the interest. That's now the second largest government expense behind Social Security. Bigger than defense, bigger than Medicare, bigger than everything except Social Security. And now the smart money is running. Vanguard, with $11 trillion in assets under management, just flipped their entire investment thesis. They're recommending investors abandon the traditional 60-40 portfolio. 60% stocks, 40% bonds. That's been the gold standard for decades. The safe, boring, reliable allocation that financial advisors have preached since the 1980s. Vanguard just said, flip it. Go 40-60. 40% stocks, 60% bonds. More defensive, less risk. Lower returns, but safer positioning. Their chief economist called it a tectonic shift. Not a small adjustment, not fine-tuning, a tectonic shift. Those are his exact words. This is not investment advice, this is survival positioning. The smart money sees something coming, something big, something that makes them willing to sacrifice returns for safety. And they're not alone. In the last 2 weeks of December 2025, institutional investors moved over $1 trillion, selling tech stocks, selling the Magnificent Seven, Nvidia, Microsoft, Apple, Amazon, the winners of the AI revolution. The stocks everyone believes are invincible. They're dumping them, not because these companies are failing, not because AI is dead, because the valuations are stretched, because the risk is too high, because when the system breaks, nothing is safe except real defensive assets. This is not a prediction. This is not speculation. This is pattern recognition, and the pattern is absolute. Let me show you. Every great financial system follows the same 4-stage pattern. Every empire, every currency, every government that tries to spend its way out of fiscal reality. The pattern is unchangeable, inevitable, mathematical. Stage 1, the foundation. Every system starts with sound money, real value backing the currency, gold content, silver backing, something tangible you can hold, something that cannot be created from nothing. The government spends what it collects, citizens trust what they hold, trade flourishes naturally, prices stay stable because the money supply grows slowly, matching actual economic output. This is the foundation, the starting point, the moment before the temptation becomes too powerful to resist. Stage 2, expansion and debasement. But then something changes. War, infrastructure projects, social programs, imperial ambitions, crisis spending. The government's appetite exceeds its income. Tax revenues aren't enough. The population resists higher taxes. But the spending must continue. The promises have been made. The obligations are mounting. So they discover the shortcut, the trick, the seemingly brilliant solution. They debase the currency. At first, it's subtle, barely noticeable. Just a small reduction in precious metal content. Just a slight increase in money supply. Just a temporary measure until prosperity returns. Nobody notices at first. The coins still look the same. The bills still have the same numbers printed on them. Life continues normally. But the government has crossed a threshold. They've discovered how to create purchasing power without creating value, how to spend without taxing, how to make promises without constraints. And once discovered, this power is impossible to resist. Stage 3, crisis and loss of control. The debasement accelerates. What started as 5% becomes 10%, then 20, then 50. The government needs more money for more promises, for more problems that the previous debasement created. Prices begin to rise, slowly at first, then faster, then exponentially. Citizens notice their purchasing power declining. Merchants begin refusing the debased currency or demanding more of it. The government responds by printing even more, creating even more debasement, accelerating the death spiral. Trust evaporates. People start hoarding real assets, land, commodities, gold, anything with actual value independent of government promises. The velocity of money increases as everyone tries to spend the worthless currency before it loses even more value. The government implements price controls, wage freezes, mandatory acceptance laws, capital controls. Everything designed to force people to accept the garbage currency. Everything fails. The currency becomes a joke, a burden, something to dispose of as quickly as possible. The social contract breaks down. Faith in institutions collapses. This is where it gets dangerous. This is where the pattern becomes irreversible. Stage 4, the inevitable outcome. The system breaks completely. The currency hyperinflates or gets abandoned entirely. Trade collapses back to barter. The government loses its ability to fund basic functions. Social order deteriorates. Those who saw it coming and positioned themselves in real assets survive. Those who trusted government promises and held the currency are wiped out completely. A new system eventually emerges, usually backed by sound money again. The cycle resets. And within a few generations, when the memory of the collapse has faded, the pattern begins again. This is not theory. This is not my opinion. This is documented historical fact. Let me prove it. 2nd century AD. The Roman Empire controls all of Western Europe, parts of North Africa, the Middle East. 65 million people under Roman rule, 20% of the entire world's population. The denarius is the global reserve currency, pure silver, 4.5 grams of it, accepted everywhere from Britain to Mesopotamia, trusted completely. For 2 centuries, the denarius maintains its purity. The empire thrives. Trade routes span 3 continents. Roman engineering builds roads that still exist today, aqueducts, cities. The legions defend the borders. Tax collection is efficient. The budget mostly balanced. This is stage 1 working perfectly. But maintaining an empire is expensive. Military campaigns cost fortunes. The borders keep expanding, requiring more soldiers, more forts, more administration. Social programs multiply. The Roman grain dole feeds hundreds of thousands. Entertainment costs soar. Nero builds his golden house. The silver mines are depleting. Revenue can't keep pace with spending. So Nero makes the fateful decision in 64 AD. He reduces the silver content from 100% to 93%. Just 7%. Barely noticeable. Just a temporary measure. Subsequent emperors follow suit. Each one debases a little more. By Marcus Aurelius, the denarius is 75% silver. The foundation is cracking. Look, I'm not asking you to believe me. I'm asking you to look at the data yourself. Every single source is linked in the description. U.S. Treasury official databases, congressional reports, Federal Reserve data, real-time debt trackers. It's all there. Bookmark those links, check them weekly, watch the numbers climb in real time. Because once you see it with your own eyes, you can't unsee it. And that's when you'll understand why the smart money is moving right now. 3rd century AD. The crisis of the 3rd century, historians call it. The Antoninianus replaces the denarius. It's supposed to be worth 2 denarii, but weighs only 1.5 times as much. By 250, AD coins are barely 5% silver. Bronze cores with thin silver coating. The coating wears off within weeks, revealing the fraud underneath. Prices explode. What cost 1 denarius now costs 50, then 100. Then hundreds. Soldiers demand higher wages. The government prints more debased coins to pay them. The spiral accelerates out of control. Emperor Diocletian in 301 AD issues the edict on maximum prices. Price controls on over 1,000 goods and services. Penalty for violation? Death. Execution for charging too much for bread? It fails completely. Merchants stop trading. Black markets flourish everywhere. Barter replaces currency. The monetary system collapses entirely. By the end of the 3rd century, prices are 70 times what they were 2 centuries earlier. Most of that increase happened in the final decade. The social contract has shattered. Tax evasion becomes universal. Regional strongmen emerge. Central authority crumbles. The Western Roman Empire enters terminal decline. It will limp along another 2 centuries before final collapse in 476 AD. The exact same pattern, stage 1, stage 2, stage 3, stage 4, every step perfectly predictable. November 1918, World War I ends, Germany loses. The Treaty of Versailles imposes devastating terms, territorial losses, military restrictions, 132 billion gold marks in reparations, an impossible sum designed to cripple Germany for generations. The Weimar Republic inherits this burden, a fragile democracy trying to govern a broken nation with an impossible debt. Pre-war Germany had sound money, the gold mark, stable, trusted, backed by one of Europe's strongest economies. German industry was world-class. The currency reflected that strength. Stage 1. But the reparations are crushing. Tax revenue is insufficient. The population is exhausted, impoverished, unable to bear higher taxes. Yet the payments must be made or France will invade. The government begins printing money. Quietly at first, the mark begins losing value. 4 marks per dollar becomes 8, then 16. In 1922, Germany misses a reparation payment. France and Belgium occupy the Ruhr Valley, Germany's industrial heartland. The government orders workers to resist passively. Don't cooperate, don't work. Strike. But striking workers still need to be paid. The industrial output has collapsed. There's no revenue to pay them, so the government does what failing governments always do. It prints massive amounts of currency. The printing presses run 24 hours a day. The debasement goes exponential. January 1923, a loaf of bread costs 250 marks. November 1923, the same loaf costs 200 billion marks. Not million, not trillion. 200 billion marks for one loaf of bread. People carry wheelbarrows of cash to buy groceries. Workers demand to be paid twice a day so they can spend the money before it becomes worthless. Savings are obliterated overnight. The middle class is destroyed. Pensioners starve in the streets. The velocity of money accelerates to insane levels. Nobody wants to hold marks for even an hour. Real assets become the only store of value. Land, gold. Foreign currency, anything except marks. Social order breaks down. Political extremism surges. The conditions that will bring Hitler to power 10 years later are being created in real time. By November 1923, the exchange rate reaches 4 trillion marks per dollar. The currency has become functionally worthless. The government abandons the mark entirely and introduces the Rentenmark backed by land mortgages. The hyperinflation ends. But the damage is permanent. An entire generation's wealth has been confiscated through inflation. Trust in democratic institutions is shattered forever. The path to fascism is paved. Same pattern, same stages, same outcome. Inevitable. Early 1600s. The 30 Years' War is bleeding European treasuries dry. The Holy Roman Empire's German princes are desperate. Their peasant populations are broke. Tax revenue has dried up completely. But the wars must be funded. Before the crisis, German silver coins maintained consistent weight and purity. The taler. The groschen. Reliable currency that facilitated trade across Europe. Stage 1 functioning. But war is expensive. The princes discover they can debase their coinage and use the extra metal to mint more coins. Genius, they think. They hire kippers, who clip the edges of coins, and whippers who wash the silver off mixed coins to reuse it. They call in 10 coins, melt them down, add cheaper metals, and issue 11 coins. Instant wealth creation. Or so they believe. Each prince debases a little. Then a lot. Then frantically, as they realize all their neighbors are doing the same thing in a race to the bottom. By 1622, the debasement is impossible to hide. Coins that should be identical weigh dramatically different amounts. Some are mostly copper. Silver content has dropped from 90% to 20%, then 10%, then nearly zero. Prices skyrocket overnight. Merchants refuse the coins or demand 3 times as many. International trade collapses. The economy seizes up completely. Nobody knows which coins are real and which are frauds. Trust evaporates entirely. The monetary system breaks down. By 1623, the Holy Roman Empire forces the princes to stop. They recall the debased coinage and issue new currency at massive loss to coin holders. Fortunes are wiped out. An entire economic system has to be rebuilt from scratch. The lesson is learned temporarily, but within a generation the memory fades. The temptation returns. The cycle begins again. Third example, same pattern, same stages, same collapse. The pattern is absolute. Now let's apply this to the present, to America, to the global financial system. To what's happening right now as you listen to this. America's stage 1 ended in 1971 when Nixon closed the gold window. That was the moment the dollar stopped being backed by anything real. It became pure fiat currency, a promise, an IOU, faith-based money. For the first time in human history, the global reserve currency had 0 intrinsic value. It worked because everyone agreed to pretend it had value, because America's economy was so dominant, because there was no alternative. Since 1971, the pattern has been consistent. Spend more than you collect, print money to cover the difference, expand the monetary base, increase debt, repeat forever. The national debt in 1971 was $398 billion. Today, it's $38.4 trillion. That's a 95-fold increase, a 9,500% expansion in 54 years. But here's the acceleration. The debt crossed 34 trillion. In January 2024, 35 trillion in July 2024, 36 trillion in November 2024, 37 trillion in August 2025, 38 trillion in October 2025, $1 trillion every 5 months. the fastest accumulation outside the pandemic emergency spending, during a time of supposed economic growth. During the good times, this is stage 2 accelerating exponentially. Here's where we are right now. Interest payments on the debt just crossed $1 trillion annually. That's larger than the entire defense budget. It's the second largest government expense behind only Social Security. The Congressional Budget Office projects interest payments will hit $1.8 trillion by 2035, $13.8 trillion over the next decade. In the past decade, it was $4 trillion. Next decade, $13.8 trillion, a 350% increase. Interest payments as a percentage of federal revenue hit 15% in fiscal 2026. Over 15 cents of every tax dollar collected now goes just to service the debt, not reduce it, not pay it down, just service the interest. The Federal Reserve's balance sheet expanded from under $1 trillion in 2008 to over $8 trillion today. That's direct money creation, digital printing, currency debasement in modern form. When you compare the Fed's balance sheet expansion to the Roman silver debasement chart, the trajectories are identical. The rate of decay matches perfectly. The acceleration pattern is the same. We are following the exact same path. And now the smart money is moving. In the last 2 weeks of December 2025, institutional investors executed what they're calling the Great Rebalancing. Over $1 trillion moved. BlackRock, Vanguard, State Street, CalPERS. These are the largest, most conservative asset managers on the planet. They don't panic. They don't chase trends. They move slowly and deliberately. And they just moved over $1 trillion into defensive positions in 2 weeks. They're selling Nvidia, Microsoft, Apple, Amazon, the magnificent 7 tech stocks that drove the bull market, the stocks with the best fundamentals, the highest growth rates, the strongest balance sheets. They're dumping them, not because these companies are failing, because when balanced portfolios surge in equity value, they become overweight in stocks. To maintain target allocations, they must sell the winners and buy bonds. It's mechanical, they say. Routine rebalancing. But here's what they're not saying. They could change their target allocations. They could ride the winners. They could chase momentum like retail investors do. But they're not. They're deliberately de-risking, deliberately positioning defensively, deliberately preparing for what's coming. Vanguard's recommendation isn't just about rebalancing. It's a fundamental thesis change. Their chief economist stated it directly. U.S. equities are overvalued, stretched to dangerous levels. Bonds now offer similar returns with lower risk. International stocks will outperform American stocks over the next decade. That's not typical investment guidance. That's a warning. A red flag, a signal that something is deeply wrong. The 40/60 portfolio has an expected 10-year return of 5.7% versus 5.3% for 60/40. Almost the same returns. But the volatility? 6.9% versus 9.3%. Significantly lower risk for essentially the same return. That tells you everything you need to know. The risk-reward ratio for stocks has broken down completely. This is stage 3, the crisis phase, the loss of control, the moment when the debasement accelerates beyond the point of no return. The government cannot stop. $38 trillion in debt requires continuous refinancing. $1 trillion in annual interest must be paid no matter what. Social Security and Medicare are 7 years from trust fund depletion. Defense spending won't decrease in a dangerous world. Infrastructure needs are massive and growing. Tax revenue, even with strong economic growth, cannot cover these obligations. The math doesn't work. The numbers don't add up. So the money must be created. The debt must expand. The debasement must accelerate. There is no other path, no other choice, no way out except through stage 4. Former Treasury Secretary Janet Yellen just issued a stark warning. The U.S. is approaching fiscal dominance. That's the point where debt becomes so large that the Federal Reserve loses its ability to control inflation. The Fed can't raise rates to fight inflation because higher rates make the debt unpayable. They're trapped. The interest payments become an injection of money into the economy that fuels more inflation, creating a feedback loop. When Paul Volcker crushed inflation in the early 80s by raising rates to 20%, the national debt was only 25% of GDP. He had room to operate. Time for fiscal adjustment. Today, the debt is 120% of GDP. The impact of rate hikes is instantaneous. The government can't afford higher rates. The Fed has lost control. At some point, and nobody knows exactly when, confidence breaks. The world starts questioning whether the dollar will maintain purchasing power. Foreign central banks reduce treasury holdings. Demand for dollars weakens. The currency begins losing value faster. The Fed faces an impossible choice. Raise rates to defend the currency, which crashes the economy and makes debt service impossible, or keep rates low and let inflation surge, which destroys purchasing power and trust. Either path leads to crisis. Either path completes the pattern. Stage 4 becomes inevitable. And when that moment comes, the assets that hold real value will surge. Land, commodities, gold, productive businesses, Because the dollars themselves will be worth less, much less, potentially worthless if the pattern completes fully. Those positioned in real assets will survive. Those holding government promises and dollar-denominated bonds will watch their wealth evaporate, just like Roman citizens holding debased denarii. Just like German pensioners holding marks. Just like everyone throughout history who trusted government promises over economic reality. The pattern is playing out in real time. Stage 3 accelerating towards Stage 4. The timeline is unknown, but the destination is certain. Let me address the 3 things the experts will tell you. The 3 arguments they'll use to dismiss this analysis. This time is different. No, it's not. Every failing system believes it's different. Rome thought their empire was eternal, unshakable, the greatest civilization in human history. It collapsed. Weimar Germany thought their modern industrial economy could absorb the shock. It couldn't. Medieval princes thought they were clever enough to get away with debasement. They weren't. The United States thinks its reserve currency status, its military power, its technological dominance make it immune to the pattern. They don't. They just make the eventual adjustment more violent, more catastrophic, more complete. Technology will save us. No, it won't. Technology doesn't change mathematics. Productivity improvements don't change the fact that you cannot spend more than you earn indefinitely. AI won't solve fiscal insolvency. Digital currencies don't eliminate the temptation to debase. The printing press didn't save Weimar Germany, even though it was advanced technology for its time. The Roman Empire had the ancient world's most advanced engineering. Roads, aqueducts, concrete that we still can't fully replicate today. Technology didn't save them. The Kipper and Whipper crisis happened during a period of significant monetary innovation. Technology has never stopped this pattern, ever. American exceptionalism makes us different. No, it doesn't. Every empire believes it's exceptional, right? Up until the moment it's not. Rome was exceptional for 8 centuries. Then it wasn't. Spain was exceptional when it controlled New World silver. Then it wasn't. Britain was exceptional when the sun never set on its empire. Then it wasn't. American economic dominance is not a law of nature. It's a historical circumstance created by specific conditions following World War II. Those conditions are changing. The dominance is fading. The exceptionalism is an illusion maintained by people who refuse to study history. So what can you do? You cannot stop the pattern. You cannot change government policy. You cannot fix the fiscal trajectory, but you can position yourself to survive it. Understand the difference between real assets and financial promises. Real assets have value independent of government promises. Land produces food, regardless of what happens to the dollar. Commodities have industrial uses that don't disappear. Gold cannot be created from nothing, no matter how many dollars the Fed prints. Productive businesses generate cash flow in any currency. Financial promises, bonds, currency, government securities are only valuable if the government maintains its ability and willingness to honor them. History shows that ability and willingness eventually fail. Always. Without exception. Follow the smart money. Vanguard isn't recommending 40/60 because they're pessimistic. They're recommending it because they understand risk, because they see valuations, because they know what institutions are doing behind the scenes. When the largest, most conservative asset managers in the world start positioning defensively, that's not a suggestion. That's a warning. That's a signal. That's your cue to pay attention. Diversify internationally. The United States is deep in Stage 3. Other economies are at different stages, different points in the cycle. Diversifying internationally means you're not betting everything on one government's fiscal responsibility. Vanguard's own projections show international stocks outperforming U.S. stocks over the next decade. That's not anti-American sentiment. That's mathematical analysis of valuations and growth potential. Maintain liquidity, but not in long-duration assets. You need cash for opportunities and emergencies. But that cash should not be locked in 30-year treasury bonds if those bonds will lose purchasing power. Short-term treasuries, money market funds, assets you can move quickly when conditions change, when the pattern accelerates, when Stage 4 approaches. Educate yourself on monetary history. This video is one data point. Read about Roman currency debasement, study the Weimar hyperinflation, understand the Kipper and Whipper crisis, learn what happened in Zimbabwe, Venezuela, Argentina, Turkey, Lebanon. The pattern repeats because human nature doesn't change, government incentives don't change, the mathematics of debt and debasement don't change. The $1 trillion rebalancing isn't about year-end portfolio housekeeping. It's about institutional recognition that we are entering a new phase, a more dangerous phase, the phase where the pattern accelerates toward its inevitable conclusion. The Roman Empire took centuries to collapse. The process was slow, then sudden. For generations, everything seemed fine. The economy grew. The military won victories. The debasement was gradual, barely noticeable, until suddenly it wasn't, until the currency collapsed completely within a single decade. Weimar Germany took years, not centuries. The mark lost value steadily, then catastrophically. 1 million marks, 1 billion marks, 1 trillion marks for a loaf of bread. It seemed impossible. It seemed insane. But the mathematics were simple. The government needed money it didn't have. So it printed and printed and printed until printing became physically impossible because they ran out of paper. We are not at that endpoint. Not yet. We're not in stage 4. But we are deep in stage 3. The pattern is unfolding. The smart money recognizes it. They're positioning for it. They're moving $1 trillion to prove it. The question is not whether the pattern will complete. History is absolute on this point. The question is, what will you do with this information? Will you dismiss it as doom and gloom? Will you trust that this time is different? Will you believe the experts who say everything is fine? Or will you look at the data, study the history, understand the pattern, and position yourself accordingly? The institutions are moving. The smart money is rotating. The signals are everywhere for those willing to see them. Your move. Don't just watch this unfold. Subscribe to this channel for the next video where I break down exactly which assets survive systemic debasement and which get obliterated. The historical data is clear. The pattern is absolute. What's coming next will determine your financial survival. Hit subscribe, turn on notifications, share this with anyone who needs to understand what's happening beneath the surface. Because the pattern doesn't stop, the mechanism doesn't pause, and time is running out.